Good morning, everybody, and welcome back to the Schwab YouTube coaching channel for the Thursday edition of Trader Talk in today's market. I'm your host, Kevin Horner, joining you from our Schwab Denver studios. I am running solo for you, as is the case usually on a Thursday morning. So thanks to all of you for joining me. This morning, I am joined by my friend here and fellow Schwab coach, Mr. Ben Watson, there in the chat. Say hey to Ben, who will get to comments and questions I'm unable to address for you all today. But as you know, I like to keep a close eye on what's being discussed in the chat, and I'm happy to bring your discussion topics to bear here in our conversation. So please feel free to post for the duration of the show. I will try to bring those requests to the table as much as I can here on a Thursday when we do go solo like this. So let's make sure that we get to some of those symbols that you are looking for. And we can do that real easily as we talk about some of the sectors or industry groups in the market. But individual equities, typically I try to rely on those that have headlines, and I do have a number of key individual equities. So as it relates to questions that you want me to address, try and limit that to sectors and industry groups more so than individual equities. But where I can, I'll try to discuss some of those. Now, there are some moving equities that are in the news today, and some of these are going to be familiar symbols to many of you. So have no fear. We're going to get to as many as we can. So before we get into things, as always, let's get to our disclosures and we'll jump to the chart. So please remember that everything we discuss for you today should be considered informational and educational. We make no recommendations here, but we offer education of technical analysis and trade management more so than anything else. Technical analysis can absolutely be an aspect and part of your overall decision-making process, but we discourage you from making it the entirety of said process. So make sure that you're building a plan that relies on a multitude of factors and concepts when you're deciding whether to buy or sell stocks. And remember not to rely exclusively on technical analysis to do that. We will follow our traditional method here today. We'll look at the big three indices, the S&P 500, the NASDAQ 100, and the Russell 2000. We'll try not to spend nearly as much time as usual because we spend a lot of time on these major indices, understanding the trend, but we'll get to some other industry groups and sectors on the move as usual. And like I mentioned, as many of these individual stocks as we can. In fact, last Thursday, we did an example trade buying some shares in Cisco Systems. And we did a first triggers 2 OCOs. So that is a one order that when purchased triggers 2 separate one cancels other brackets. We're going to look at that trade. I think we got stopped out on a portion of it this morning with a weak open in Cisco. But we'll talk about all of that with you here this morning, everybody, over the next 45 minutes. Let's take a look at the S&P 500. We have a little bit of green to get us started. We're up about 1/3%. I'm going to lift the line I've drawn in here, everybody, because this is what we're looking for. Can we break the highs we've achieved here at about 77.80 over the last week and a half and validate a potential move even higher? Remember, as it relates to the S&P, we've talked about the depth of this triangle and what it may imply for the near term. The depth of this triangle, this consolidation window, was 383 points, and we utilized the concept of a measured move calculation, taking the depth of the triangle once broken and adding it to the, in our case, the highest high that we had, and that was that 76.20. Adding in 383 points gives you an approximate 8,003 for the SPX target. Now, that's not the only way to make that calculation, of course. Some traders would take the 383 points and maybe add it to the downtrending line. So instead of the peak ultimately at 76.20, maybe more like 75.50. And if you added the 383 to that, from 75.50, you're looking more in the neighborhood of about 79.25 to 79.35. That's just a slightly more conservative way of doing it. Neither one of these is more right than another because, of course, price action will dictate whether these measured move calculations are valid or not. But as always, our encouragement for you from an education standpoint is to utilize as many of these concepts, apply them to your charts, apply them to your trades, and then see which ones of these plans and ideas and concepts build in a manner for you that is super comfortable and gives you insights that are actionable. Ultimately, that's all we're always looking for as traders, right? We want to have signals we can rely on and actionable ideas from those signals, and putting in motion some of these trades and taking advantage of some of these opportunities from time to time is going to be how we develop our own personal process and plan. So it's very important that we all do that individually and get our process, our plan kind of solidified so that we can continue to do the exact same thing. You know, trading so frequently, for trading the market actively, the best way that I've come across to kind of think about it is that trading is honestly all about simple, repeatable, easy steps. It's a lot like the golf swing. We don't want a lot of stuff mixed in there. We don't need a lot of hitches and hiccups in our swing. We want everything to be very simple, easy, and repeatable. And sometimes the more detail we add, the more difficult that simplicity becomes, of course. So try and bring it down to a level where you're not overdoing things. So with that in mind, we have a great start. Let's see if we can pop into that 7,800 on the SPX today on a little bit of green to get us started. Let's see how the NASDAQ 100 looks here. We are up almost 2/3%, making a similar move. We talked about the bull flag breakout here, the same thing, except that the S&P is at all-time highs ready for a bull flag breakout, whereas the NASDAQ 100 is trailing, and we know why it's trailing, everybody, right? We know that this is tied directly to the allocation of the NDX versus that of the SPX. So the SPX getting some performance strength from our sectors that haven't been strong leaders for an extended period like we've seen with technology. So we know that we've had some great moves in financials, great moves in healthcare, and great moves in industrials as well. And that's why we see the SPX doing as well as we had. Here in the NASDAQ, if the tech rally is reasserting itself, then we might very well be in the middle of it as we speak here. We're at 29.9. We need to pop through this level so that we can start talking about the prior highs up here. And ultimately, that's what we're looking for, right? Once we break the bull flag, some bull traders here, bull short-term traders are going to start talking about the prior highs as achievable, and that puts us back up to around 30,750 or so, and that's about 800 points from where we are. We wouldn't mind, and we certainly wouldn't be disappointed with a nice little 3% rally into those prior highs, and then we'll see what happens if we get to prior highs. As you all know, moving to prior highs, validating prior highs, perfectly fine to be at prior highs. What we want are higher highs, not matching highs. So a breakout through 30,775 would certainly be fantastic for the NDX if we can get that type of a maneuver. And then lastly, we'll look at the small caps. Now we can say that we've got a little bit of a break here in the small caps, can't we? I'm going to lift off this little line here. This was my measured move target of the bull flag from the lows to the flag top, and now we're breaking it. So if that candle holds like that for the day, many traders are going to start targeting that ledge I drew in at around 3150, everybody. So that's an approximation of that measured move. Remember, once more, whenever we draw these measured move calculations, never a guarantee to be achieved. It's just an estimation, setting targets, an area that traders will try to look for ways to manage these positions, right, and take profits where we can. Hey, we've just been graced by Scott Thompson in the chat. Looks like Ben has got a quick hit on the Schwab network, the third party and separate but affiliated group that's owned by the Charles Schwab Media Group, of course. Not to suggest that you shouldn't be watching the show, but if you get a chance to see Ben do a network hit, you should always take advantage of that. So, hey, Scott, thanks for being here. Okay. So there's a look at your big three, your S&P 500, your NASDAQ 100, Russell 2000, all seemingly starting the day exactly the way bulls want to see. So Let's take a look at our semis, getting up 0.75%. Similar move here. We have to stay a little bit cautious only because we reside below the 50-day moving average still. We have that horizontal ledge of resistance over the last 3 weeks. Let's see what that looks like on my hourly bars. There we are. We are right at it, everybody. So remember, the interesting thing about technical analysis is that when we find ourselves at areas of resistance and support, it's the validation of those resistance or support levels that really informs us as traders. It doesn't tell us what's going to happen next, right? We don't know if a break of this ledge at 12,530 is going to occur in the semis. You might have a lean one way or the other, but if you think about this move and the potential to break through 12,530. The real question is, what steps do the bullish trader take if we break through 12,530? What is the potential for the next move? So many traders would say that a move through this area means we have an opportunity to rally to the next level of potential resistance. Where might that be? Well, on this chart, we could say that it could be the last highs from before. So we might duplicate this line and snap it up here and then extend it. And it could look something like this. By no means is that the only way to think about it, of course. But remember, when you take a lid off price action, you commonly get momentum moves. Doesn't mean that you'll move through and just immediately be up there, right? But it certainly increases the likelihood that we can achieve this second layer level up here, if and only if we can move through the first ledge, right? So it doesn't tell you what's going to happen, but it does say, well, if I believe that a move through 12,530 could mean a move ultimately to the next level at 13,230, well, then the trader says, yeah, if I think that can happen and it doesn't, then I sure need to be thinking about moving on if we make a move through the last low. Because then this level that I've got in white, I'll turn to red, then all of a sudden the price action looks like a rejection at resistance, not a breakthrough at resistance. And so now in such a scenario, our opportunity for upside inverts and it's no longer looks the same. And now we have a greater risk of going lower first before potentially going higher. And the question becomes, how do we traders manage it? Do you want to stay with the full position size that you're working with? Do you want to sell some? Do you want to use that as that weakness as an opportunity to add some, etc.? All of these are thoughts that traders need to manage and maintain in our heads at the same time. It's really one of the things that makes it difficult as a trader to manage all of these viewpoints. And some of you will rely, as you may want to, on notes and availability for detail in your orders. Don't forget to utilize some of those functions here in the Thinkorswim desktop application. It can ease the burden of remembering what your plan was, perhaps. So, okay. Hey, we have a survey opportunity, everybody. Looks like in the chat. So take a minute. I always appreciate and love hearing from you all because your insights help me really drive, especially my Thursday classes when I'm here with you solo. So I would love that opportunity to hear from you. Any comments you put in addition to a score, those come to me directly and are very helpful in developing the Thursday class. So please take a minute. If you click that link right now, it'll open in a browser window right next to this one, and you can get to it post-class. And those insights will come to me here in the next 24 hours, and then I'll build them in for subsequent sessions. All right, let us take a look. One of the areas of the market that we haven't looked at of late has been transport. So let's drill into the three legs of the transportation stool, everybody. Here is our transports group collectively. We still have a bit of an uptrend here. 20 and 50-day moving averages were below, but we do clearly see higher lows, higher lows, higher lows, right? So we know we have an uptrend in place, okay? Now, let's see if we can put a proper moving average on here that would be a little bit more consistent since it's not the 20 nor the 50. How about the 100? Okay. Hey, that's a little bit of a learning something or other, right? Check that out. We've had a big move back in the late fall last year when we went above the 100-day moving average and have held it since in the transport. So joining the trend here has been relatively easy if you were the believer that you should be doing so in the vicinity of the 100-day simple moving average. And look where we happen to be now. All right, so are we looking at a spot where transports could be relatively comfortable for those looking to add exposure? Based on the trend of the last 9 months, many traders would say yes. Now, the key here, of course, is to be thinking that if I were to apply new money to this trend, I might look to be making changes to my thesis about applying dollars now if we traded under the lows we just made, right? Because that would be something different versus what we have seen. Okay. And so new dollars. And so when we say things like the 100-day simple moving average becomes an area for traders to possibly expose more money in a low risk area. Why is it low risk? It's only low risk if the trader says, yeah, I'm moving on when the trend changes. And under the white line I just drew in, everybody, on a closing basis, maybe for one day, maybe for 2 days, maybe the Horner rule with 3 days below former support could mean a larger move to the downside. It could mean a breakdown from this uptrend that appears today to be fairly obvious. But if that were to change, well, then we traders have to have a step we have to take some kind of step, right? That says, okay, this trend is not the same. I need to do something. For many traders who buy in along the trend line like this, if they're wrong and the trend shifts, they move on quickly. Okay. So that's what we're going to talk about with regard to the transports. Now, let us also look at the pillars, if you will, of this space. And those are, of course, our airlines, our trucks, and our rails. So let's peek in here at the airlines to get us started. And we'll see if any of these are tracking the group clearly. So here we've got airlines, which is not quite tracking the group, is it? The 100-day moving average has not been the simple trend that we would prefer. The bigger detail as it relates to a lot of these is going to be oil, of course. And so we'll look at oil momentarily, but the movement in oil here has been dictating a lot of the bigger swings in the airline stocks. Let's look in on the truckers. Now that's a chart that seems to resemble the broader transportation index, does it not? With our 100 period moving average, our 100-day offering support, higher lows in there as well. So this seems relatively in line with the broader space, but still worth watching. I'll put up all the moving averages there for you to give us something to look at. Now, if you're that trader who says, boy, I'd prefer to be trading the 20-day, well, then you're just being a little bit patient through here, right? Because apparently we are right around resistance in here, right? We're at the 20 period. We could see that we'd been resistant at this level previously, so it could be resistance today as well. So don't, in this situation, a lot of traders would say, I'm going to force price action, make prices get above a level of resistance before I'm validating that. And then, of course, how about our rail stocks? Let's take a look there. All right, so of the three, everybody, here's what we could say. We've got airline stocks not looking like the broader transportation space, but in a bullish trend, broadly speaking. You've got truckers that seem to be a lot more trading like the trend of the transportation sector or group itself. And then thirdly, we've got this rail stock group, which seems to be outperforming. Look at how well this is doing collectively. We are at the 20-day once more, but well above the 100-day simple moving average, even though the 100 has been opportunity. So for a lot of traders who want to be in rail stocks, yeah, maybe the support we've made over the last month and a half here could be the lowest we see in the near term. That could be an area or a reason to expose money, but you can see that collectively, our best opportunity for participation here has also been retreats to the 100-day simple moving average. So give thought to that as well. Now, let's go ahead and use this as our impetus to look in the big ones on oil, everybody. So we're going to hit up crude to get us started. Now, there was a note I had on crude this morning, so give me a quick moment here. Wanted to find it. All right, so we have oil prices down at, the EIA crude inventories went up on Wednesday, and the IEA said that global demand was set to fall further than previously was expected this year due to the deepening closure of the Strait of Hormuz. Now, looking at oil again, we use the futures symbol here. This is not an encouragement for you to trade futures. It is a reminder that you can trade futures at Schwab. You do need to be approved in order to do so. So make sure that you go through the requisite steps to do just that, everybody. A very important aspect of it. But when we're looking at the move in oil, we still see we are banded between the descending triangle. Many lower highs, another lower high we just made this week, and now it's trying to kind of selling off. So, truth be told, I think a lot of traders are more or less just watching the downtrend and horizontal support. So the downtrend rallies into the downtrend have been sold consistently since the peak. So until that changes, there's not really a whole lot to do. And the back and forth we're getting in the form of, or within, I should say, this descending triangle makes it, kind of difficult to decide which side of the market to be on at any given moment. The truth is that a lot of traders are waiting for a move outside of the white lines drawn on this chart. Let's extend that out to just gasoline. I filled up just 2 days ago, and I'm not getting any relief at the tank just yet. We bounced a little bit the last week off of these lows. This is less of an important look from a macro standpoint. The one that a lot of traders lean into from a macro standpoint, we like to check on the heating oil as a bit of a proxy relative to the diesel fuel. And this is a kind of a broad or generic, if you will, look at it. But we talked about the break here, downtrend line break, rally up to resistance, and then a pullback to the major average, the moving average that it was respecting, and that was the 50-day. Well, I think we've gotten confirmation that the 50-day is near-term support. We'll see. Right now, movement above the highs we just made around 438 would be fairly bullish and difficult perhaps for the market. Remember that diesel and diesel works so it's such a big component of inflationary calculations. It often, as diesel rises, what we notice is the increase in costs across the board, especially for those goods that we transfer cross country in trucks as opposed to rails. So bear that in mind as well. Okay, so there's a look at your big three from the oil side of things. We'll go ahead and extend into the sectors. Remember that survey's out there for you, everybody. Thank you so much for reposting that, gentlemen. Let's see how energy is working. Energy is pausing. We talked about this a little bit, the potential for a pause at resistance. It looks like now that I can color that red because we have taken our pause, haven't we? If we zoom back in, yesterday was our high day. So could we get a little bit of a pullback here if we get under yesterday's low? Yesterday's low in this space, 924.26. Watch that low and see if it picks up momentum to the downside if taken out. One other note down below is that we have a bearish divergence down here from the last time. So we made a higher high in price, but a lower high in the RSI. Now, remember, when we start talking about lower highs and or divergences like this, um, the issue isn't that this is a increased likelihood of a reversal, but rather that it may mean a simple pullback uh, as opposed to a reverse altogether. So, what I mean to say is this could be worked off by the passage of time, this divergence, the passage of time, or the test of the 20-day moving average. Remember, we've talked about it being supportive since we jumped above it on July 8th. And so if that is the case, we could easily witness a pullback to the 20-day necessary to before we could see energy space collectively moving higher. That's a possibility. That does not mean reversal all the time. Okay. I wanted to answer a question. Let me just get back to it here really quick. Oh, Barbara, your question about heating oil as a proxy, it comes down to the component, the makeup of these fuels. It's ultimately a chemistry situation, if you can believe it or not. They're relatively similar in chemical makeup and then price tracking as a result of that. So heating oil is often used for economic stuff, economic. Um, uh, excuse me. It's frequently used as a direct economic and physical proxy for diesel relative to trading the market. And it's all tied to the makeup or the components, if you will, of that chemical compound for diesel and heating oil being so similar, if not almost identical. So that's ultimately why we can use something like heating oil as a visual, if you will, just from understanding the macro side of things. I hope that's somewhat helpful for you there, Barbara. Okay, next we talked energy. Let's also make sure we hit up on some of these bigger groups moving today. What's this one up 1%? Ah, technology. Great. We love it when technology's in gear, don't we, everybody? Take a look. What do we have? A bit of a, boy, this looks like a flag in a stiff wind all of a sudden, doesn't it? Where we've got higher highs and higher lows. Some would say it's a rising wedge and they don't like those things. But when it's, I'll tell you what, now that we're through the highs we've made here this last week, many traders are going to say, yeah, there's the path of least resistance is those prior highs that we've made. So doesn't mean we have to get there, but it becomes a potential target for the short-term trader. Nice move today, up 1.1%. Okay, what do you say? Let's see, we've got about 15 minutes remaining. Let's go ahead and hit up a few more of these sectors quickly just to make sure we touch on some of our better performers here. So here's a look at industrials, which continues to hold the breakout. Remember, this is one of the harder things I believe for traders is the idea that the prices get to a level and then price doesn't really go anywhere. This is one of those situations where traders might have their patience tested because price isn't moving, but the maintaining of the level here that where my crosshairs resides, because it's outside of that downtrend line, is going to appear to be more bullish, even though it's not a scream to the upside immediately following the breakout. What appears to be going on here is the move higher has held, and the 20-day, this pause after the breakout, having gone sideways like it has for about 7 or 8 sessions, is enabling the 20-day to catch up in here. And remember, when we get breakouts, traders often start looking for the new trend. So consolidations, pullbacks, etc. When those occur, the trader waits for the breakout, and then when the breakout happens, we expect the trend to begin thereafter, which is to say a window like this. Remember, back here in industrials, you can go back to when we kind of started making this move. I was looking at this as resistance, right? And we got through it. We had to get thrown back to our moving average. But see how once we cleared it with any conviction, we started to trend. And that's when our 20-day became pertinent for us, didn't it? And it became pertinent for Well, let's see here. How long were we above it? From all the way back here to when we actually broke down? 65 bars approximately. So what are we looking at? So 5 and 60 would be 4 months. So about, yeah, right around 15, 16, 17 weeks. Admittedly, that's a little bit longer than most. Commonly, you'll see a 20-day moving average run like that go between 8 and 12 weeks. This one went a little bit longer, but it's as simple as managing the trend, waiting for the break below the 20-day and then moving on, right? Or being patient and waiting for it to get picked up again as support, right? So manage our process as much as we possibly can. So industrials, breathing a little today, good strong trend nonetheless. Discretionary continues to be difficult. We're not getting trends out of this one just yet. This chart is just a mess, right? And I'll often say it, we don't need to spend a long time looking at a chart. If you look at the chart and the first thing you say is a completely involuntary, ugh, move on. Look at the next chart, everybody. There's no reason to be forcing trades here. Look at the consolidation in staples. We're not getting anything just yet, but a break of these lines would be a significant development. We'll continue to monitor staples. Here we've got healthcare moving higher. We talked about healthcare yesterday. It's not the 20-day simple moving average, everybody. I'll make the adjustment here for you to the 30. Look at how clean the 30 has been, everyone. Wow. Dating back to when we broke out and thrown back to it, you have held the 30-day since June 3 very cleanly. In fact, you've probably held it since we broke it originally here back in May 19. So that's a real lengthy trend there on healthcare. Using the 30-day doesn't mean that's the right one. It's just the one that has been most respected for about the last 3-4 months. So if and when that changes, that could become a significant development, but obviously we are not there yet relative to healthcare. There's your financials rolling along. The 20-day hasn't even been remotely tested here. So maybe this one is a manual trend line, something like so. You could draw it like that. 10-day probably too tight, right? You could manage that way, but you might find yourself a little more active than you want to be, perhaps. So keep that in mind. But this is a real strong move in financials from what we've seen. We talked tech. Here's communications, a bit still in the down channel, but if we're being patient, it's hanging out at the 200-day moving average. On the longer term, it's the 50-week moving average. So depending on your time frame, depending on your view of things, this can continue to work. Even though it is in a, kind of a down channel in the shorter term. But remember, communications is so heavily weighted towards those two big boys, the Alphabet and Meta in the position in the overall group. So keep that in mind. Now today, one thing that I am noting is a bit of a pullback rather in yields. So yields falling, boosting the market broadly speaking. Not a surprise that the Russell is breaking out while we're getting that pullback, but it is helping utilities rally off of a double bottom. It's not it is a double bottom, but you're not getting any real divergences here, so it's not a necessarily a scream in any way. It is a fairly obvious level of short-run support for utilities. And if I was to draw a trend line through the peaks, it would look something like that. And then here's your REITs. Remember, REITs are different. This is not the commercial, or excuse me, this is more commercial real estate. So, right, this is like more likely your real estate investment trust, which do carry higher levels of risk and are not the same as standard equities. So you want to be aware of that if you're thinking about this space. There is a bit of an uptrend working here, but we do note that there is a common relationship amongst the move in rates as it pertains to both utilities and real estate. They are sensitive to rates. And so when rates drop, these are two groups that do tend to get a little bit of a bounce. A significant pullback in yields would be wonderful for the broader market, but would also be potentially beneficial for both real estate and utilities. All right. Don't mind doing that, Katerina. Let's take a look. Looking for gold and silver. We'll touch briefly on these. Again, using futures symbols, everybody. We'll look briefly at gold. Again, not advocating for futures. Remember here, we have pushed into the 200-day moving average. We've been below it for how about 2 months? So, yes, we have a broken downtrend line, I think. Let me see here. Where's our peak? Something like this. We do have a broken downtrend, and so some traders might have taken position based on such a move. But at the same time, we've run ourselves into former support, potential resistance. So what might a trader expect? Maybe a pullback to the confluence of the 20 and the 50, but this is a bullish and potentially positive signal with the 20-day crossing the 50 to the upside. Remember what we said about the so-called the Kablode, as it is. It's the inverse of the Kahold. We had a high trade today. So if we take out the low over the next week, take out the low of today, this could mean a pullback to support. Where could support be? Certainly could be the 20-day. It could even be a speedier 10-day. It doesn't even have to be either of those. Maybe it's some kind of horizontal level of support. Maybe it's a Fibonacci move looking at the breakout day. The day that this got going in earnest, it might look something like this. And then a trader could expect a pullback of about half of that move. And that would mean right to the 10-day, as it were, oddly enough. Always fun when that kind of stuff lines up, right? So there's a very brief look at the gold. Let's take a look at the silver. And a little less exuberant to the upside here of late. But a lot of what we just stated for gold can be applied to silver. And we could say that the difference here is that we haven't broken the downtrend line. If we wanted to if you drew it as I have at least, and you wanted to make sure to capture that high there, we could still be at the downtrend line. So a bit under pressure. Let's look at the dollar while we're here quickly. And we see that the dollar has really retreated quite nicely. This has also been helpful to the lift in the broader markets over the last 2 weeks. So this dramatic move down has been quite nice. Okay, I think that's going to cover us for the macro side of things. Let us get to the fun stuff. Let's start talking about some of these individual equity charts for you, everybody. I've got some changes to some details. Last week, we traded Cisco Systems. Let's put Cisco into the chart here. So Cisco had earnings today. You can see what we did was a first triggers two OCO brackets. It let us buy once and then have a bracket to sell above and a stop below. And we got stopped out with today's initial weakness on half of our trade. We're in the other half still. We've got an exit strategy that'll get us out of those shares up here at 135 or down here at approximately 107. No guarantee of price on our sell stop order, of course, but that is basically leaves the trader with the idea, in our case, do we need to do anything? No, I have the bracket. I can sit on my hands. One of those two trades is going to execute when price gets to one of those two levels. I don't need to do anything in the meantime. I can just let my the work that I did in building the trade just to play out over time. And that's exactly what we're going to do with Cisco. Now let's talk a little bit about what happened with Cisco. Why is Cisco off 8% today? Wells Fargo analysts raised the price target on Cisco today up to 150 from 130. They are maintaining an overweight rating. This was following Q4 results yesterday, stating that the fiscal year 2027 guidance should provide confidence in their networking super cycle, as well as the company's Silicon One and Acacia Momentum. So they love the supply chain execution opportunity. Wells Fargo, less concerned about the initial reaction and looking forward based on guidance. KeyBank raised the target on Cisco to 135, up from 130 on their higher estimates as well. They maintain an overweight rating. Morgan Stanley raised the target to Cisco to 135 also. So a very clear 135 for both KeyBank and Morgan Stanley. Wells Fargo at 150. Again, none of these targets are guaranteed to be achieved. We also had an upgrade in some interesting stocks. So Wolf Research spent the last couple of days updating some healthcare companies. Now, you know, and I know we've been watching healthcare. So let's talk about some of these upgrades and see how these charts look. First of them is Abbott Labs. Abbott Labs upgraded to outperform from peer perform and a target at 130, stated that the firm sees company's organic growth ramping up in 2027. Here once more, that 20-day simple moving average catching up to the 200-day, giving the impression that things are improving. This is a development because we're above the 200-day nicely, but we got to go back in time to see the broader, longer trend here. Boy, is that a deep pullback. So just on balance on this chart, we know we have a short-term uptrend, right, off of the May lows to where we are, which, by the way, is tremendous, 82 to 112. So it's a 50% rally. That's wonderful. That said, look at former resistance that became support, and it was this range in here. So what should we do? We should probably extend that out. And even if we were fairly bullish, we might expect that any rallies that we get in Abbott could take a breather at the prior high right here around 116. Could it get into this little bit of a gap zone before losing momentum or taking a pause? It sure could. But the significant development perhaps would be to trade through the upper level of that rectangle around 120, because this was such a clear descending triangle at that time, right? And then once it broke aggressively with a gap and then a rally back into resistance, in this case, the 50-day. So this bears watching. But, you know, when you get significant changes to trend and they're coupled with an analyst upgrade, it can be helpful to the stock's price action. Okay. Yeah, there's another one here. Unfortunately, it wasn't Lilly. Another one was AbbVie. Wolf upgrading AbbVie to outperform from peer perform. New target here, $300 a share. A nice 20% premium to where we're trading today. And no guarantees. But when we look at what's going on here, we might have said, boy, this was a nice development. In advance of the earnings that occurred, the break of the downtrend line happened, and a trader who took that breakout, boy, have they been rewarded, everybody. 230, it ran all the way to 266 before trying to confirm short run support at the 50-day moving average, which looks like a pretty important level in the near term here on AbbVie. So $300 target, the firm citing the company's attractive valuation relative to their peer group, lack of near-term loss of exclusivity exposure for that upgrade. AbbVie also has a solid catalyst path going forward with high single-digit revenue growth in 2027. And then lastly, Wolf went ahead and upgraded Biogen to outperform as well. $300 price target on this one, a significant premium to the current price, you can see. Now, when we talk about, you know, stocks getting upgrades and whatnot, my goodness, this one really led the upgrades late to the move, obviously, but it's an improving chart over the last couple of years. If you're wondering about why traders who believe in technicals trade on technicals, well, once you get broken down trends, things tend to improve. That's what you've had here. The move in Biogen has been fantastic, everybody. To where we are right now, the stock is up 90% over the last, say, 15 months. It's a great move, casual relative to what we get in the way of technology movements, but a pretty well-established trade. Let's see, is it the 100-day moving average through here? Pretty nicely is. Yeah, has been at least. So that's kind of helpful as well. And of course, if we backed this off and put it into a weekly, well, that becomes even more interesting, doesn't it? A really important spot. Notice how we have had a lot of back and forth here at the 200-week moving average. Perhaps a break of these highs could be the kind of thing that brings some more momentum into this position. Guys, there is a survey out there. Again, I would love to hear from you. Your thoughts, your feedback, quite helpful to me. We're going to go ahead and run out of time, unfortunately, but we'll be back. There's more to come from us here on the channel. We've got another class beginning at 11 a.m. Eastern today. From my standpoint, you can follow me, follow Ben, follow Scott on X. We love hearing from you there as well. In fact, that's the one spot that we can absolutely engage with you. So if you've got questions about posts that I make on X, you can put those questions right on X, and we're actually able to reply there. What we can't do is reply to you directly via email, however. So if you reached out on X, that gives us the chance to reach out to you and answer your questions. So big thanks to both Scott and Ben in the chat. Big thanks to all of you for being here and participating. Take a minute to fill out that survey. Hit the thumbs up for us down below. We'll get this into the archive as quickly as we can. And make sure you're subscribed to the channel, everybody. Always appreciate hearing from you. Have a fantastic Thursday. I look forward to catching up with you all again real soon.